Hello class, we're going to do a couple little ratio problems just to make sure you know kind of how to do it and just let you think a little bit. That's important. So let's say we have this problem. We have the debt ratio is 60%. So what is the equity, debt to equity, and what is the equity multiplier? Well, there's not any information on this problem except, hey, the debt ratio is 60%. So here's what I'd recommend that you do. I would just create a little problem over here that shows this. So let's say our assets are, let's just pick a number like 1,000. If our assets are 1,000, how much is our liabilities? Well, 60% of that would be 600, and then equity would be 400. Okay, now the important thing is you pick a number and just build ratios based on that. It doesn't matter what number you pick. You can pick 100 or 1,000. Those are easy to do. It could be 5,000 and just run 60% times the assets. That's the debt. Well, what is debt to equity? By the way, I just put the formulas over here on the side. Total liabilities divided by total assets. Debt to equity is debt divided by equity. Equity multiplier is assets divided by equity. Just in case, it's helpful to kind of write that down and make sure you don't make any mistakes. All right, so what would the debt to equity be? Well, the debt to equity would take debt, liabilities divided by equity. So apparently, if our debt ratio is 60%, then our debt to equity is going to be 1.50. Well, what about equity multiplier? Equity multiplier is total assets divided by total equity. So total assets of 1,000 divided by your equity of 400, well, it's 2.50. Now, here's the little secret. If debt to equity is 1.5, then equity multiplier is 2.5. It's always one more. Well, why? Well, we talked about this earlier. If you look at the two formulas, liabilities divided by equity and total assets divided by equity. Well, liabilities divided by 400, 600 divided by 400, or if you add equity and liabilities together, you get assets divided by the 400. Well, equity over equity is 1.0. So moving from debt to equity multiplier, which is assets to equity, means it goes up by 1. Okay, problem 2. Let's say the debt to equity is 3.25. Well, what's the debt ratio and what's the equity multiplier? Well, let's just make something where this is true. Debt to equity. So this is debt to equity. So our debt, let's make our equity 100. And what would our liabilities be? Well, our liabilities would be 100 times 3.25. So it would be like 325. And our assets would be the total of those two, which is 425. Now, you could start with 1,000. Same ratio, doesn't matter. All right, so what's our debt ratio? Our debt ratio is our total liabilities divided by your total assets. So that's 70%, 76% and a half, basically, debt. So you might be thinking, hey, that may be too much debt. You got to figure out what's the appropriate amount of debt. That's one thing accounting doesn't really speak on. Is it just says, hey, here's the debt that you have. This is debt. This is equity. But in some ways, the finance topics are more, hey, how much debt is appropriate, right? Should we have less debt? What's the cost if we increase our debt? What's the cost if we decrease our debt? All right, equity multiplier is going to be the total assets divided by the equity. So instead of 3.25, it's going to be 4.25. Now, if you remember debt to equity plus 1 equals equity multiplier. Well, let's do the third one. Let's do equity multiplier. What if equity multiplier is 1.70? Well, equity multiplier is total assets divided by total equity. So let's make equity 1,000. And so that means our assets would be what? Well, 1,000 times 1.7, right? So that means our liabilities would be 1,700 minus 1,000, or 700. So what's our debt ratio? Our debt ratio is liabilities divided by assets. Our debt ratio is 41% here in this case. What is debt to equity? Well, debt divided by equity is 1,000. So it's 0.7. Now, 0.7 plus 1 is 1.7, so you could take Equity multiplier minus 1 gives you debt to equity. All right, new type of problem. Let's say we have given information. We have given information, we have the income statement here, and we're missing a lot of information on the balance sheet. Okay? We also know a few things. We know the accounts receivable turnover is 10. The inventory turnover is 4. The return on assets is 6.25. And our debt ratio is 40%. So here's our assignment. Just complete the balance sheet. Just plug in all the numbers on the balance sheet. I think this is a really, really good problem to help you think and make sure you know what's going on. Okay, so one thing we want to do is there's just not enough information here. We're going to have to work these ratios. So accounts receivable turnover is 10. Our accounts receivable turnover is sales divided by accounts receivable. We know the answer is 10, and we know our sales are 100,000. So what is our accounts receivable? Well, accounts receivable of 100,000 divided by the 10 means accounts receivable is going to be 10,000. So we know the accounts receivable balance here is going to be 10,000. Okay? Now our inventory turnover is cost of goods sold divided by inventory, and we know it's 4. We do know our cost of goods sold is 66,000. So if we take 66,000 divided by 4, then we must have inventory of 16,500. So our inventory is 16,500. Okay, we're working our way down the balance sheet. Now, what is our total current assets? Well, apparently it's 36,500. Now, we either need to know our property, plant, and equipment or our total assets, and we can get the other one. So let's keep going and see what we can figure out. Return on assets is 6.25. 6.25. We know net income is 5,000. We know then our assets would be 5,000 divided by 0.0625, right? So that means our assets must total 80,000. So here we know our assets are 80,000. Now here's where people get tripped up. They forget the balance sheet has to balance, right? And so you can complete this side, but then you think, well, I'm stuck, right? I'm stuck. Well, you're not stuck, because you know if assets are 80,000, liabilities and stockholders' equity has to be 80,000. All right, let's do the last one, the debt ratio. We don't know our debt, right? But we now know our assets. Our assets are 80,000. Our total assets are 80,000. We just calculated that, right? So our debt would be 80,000 times 40%. So it looks like our debt would equal 32,000. Now on this one, we only have long-term liabilities. So apparently, long-term liabilities, we're only missing long-term liabilities. So here, our total liabilities are 32,000. So that means we can back in to find our long-term liabilities. 32 minus the 14 equals 18,000. We can back in to find what is our stockholders' equity. Well, it's 80,000 minus the 32,000. Our stockholders' equity must be 48,000 here. And our property, plant, and equipment would be 80,000 minus 36,500. So that's 43,500. So we've completed our balance sheet just by knowing income statement numbers, a couple of balance sheet items, and then knowing financial ratios. So you can work backwards if you wanted to with some of these financial ratios. So I like these types of problems just to kind of help you think, because you're probably not going to be preparing a big income statement, but doing financial statement analysis, doing ratios, financial ratios, are going to be really important for you, kind of way to think and way to kind of investigate what's going on. All right, this is our last video for our intermediate accounting boot camp. So, good job.